Hey guys, welcome back to our channel. And today we're going to be going on thefool.com and we're going under the investing basics tab. And under investing 101, we're going to do how to invest in stocks, a beginner's guide for getting started by Matthew Frankel. This was updated February 13th of 2024, so it's pretty relevant and new. So let's begin. How to invest in stocks, a beginner's guide for getting started. First, determine your investing approach. The first thing you want to consider is how to start investing in stocks the right way for you. Some investors choose by individual stocks, while others take a less active approach. Try this. Which of the following statements best describes you? I'm an analytical person and enjoy crunching numbers and doing research. I hate math. I don't want to do a ton of homework. I have several hours each week to dedicate to stock market investing. I like to read but about the different companies I invest in, but I don't have any desire to drive into anything math related. I'm a busy professional and I don't have time to learn how to analyze stocks. The good news is that regardless of which of these statements you agree with, you're still a great candidate to become a stock market investor. The only thing that will change is how. The different ways to invest in stock market. Individual stocks. You can invest in individual stocks if and only if you have time and desire to thoroughly research and evaluate stocks on an ongoing basis. If this is the case, we 100% encourage you to do so. It is entirely possible for a smart and patient investor to beat the market over time. On the other hand, if things like quarterly earning reports and moderate mathematical calculations don't sound appealing, there's absolutely nothing wrong with taking a more passive approach. Index funds. In addition to buying individual stocks, you can choose to invest in index funds, which track a stock index like the S&P 500. When it comes to actively versus passively managed funds, we generally prefer the latter. Index funds typically have significantly lower costs and are virtually guaranteed to match the long-term performance of the underlying indexes over long periods. And the S&P 500 has produced total annualized returns of about 10%, and performance like this can build substantial wealth over time. Robo-advisors. Finally, another option that has exploded in popularity in recent years is the robo-advisor. This is a brokerage that essentially invests your money on your behalf in a portfolio of index funds appropriate for your age, risk tolerance, and investing goals. Not only can a robo advisor select your investments, but many will also optimize your tax efficiency and make changes over time automatically. 2. Decide how much you will invest in stocks. First, let's talk about the money you shouldn't invest in stocks. The stock market is no place for money that you might need within the next 5 years at a minimum. While the stock market will almost certainly rise over the long run, there's simply too much uncertainty in stock prices in the short term. In fact, the drawdown of 20% in any given year isn't unusual, and occasional drops of 40% or even more do happen. Stock market volatility is normal and shouldn't be expected. And should be expected. Such sharp drops have happened a couple of times in recent history. During the 07-09 bar market caused by the financial crisis, and the S&P 500 dropped by more than 50% from its previous highs. In 2020, during the early days of COVID-19 pandemic, the market plunged by more than 40% before it started to recover. So here's what you shouldn't be investing. You shouldn't be investing in your emergency fund, money you'll need to make your child's next few tuition payments, next year's vacation, money you're stocking away for a down payment, even if you will not be prepared to buy for a few years. Asset allocation. Now let's talk about what to do with the investable money. that is the money you won't likely need within the next 5 years. How you distribute is how you distribute it is a concept known as asset allocation, and a few factors come into play here. Your age is a major consideration, and so are your particular risk tolerance and investment goals. Let's start with your age. The general idea is that you get older, stocks gradually become a less desirable place to keep your money. If you're young, you have decades ahead of you to ride out any ups and downs in the market. But this isn't the case if you're retired and rely on investment income. Here's a quick rule of thumb that can help you establish a ballpark asset allocation. Subtract your age from 110. This is the approximate percentage of your investable money that should be in stocks. The remainder should be fixed income investments like bonds or high yield certificates of deposits or CDs. You can adjust this ratio up or down depending on your particular risk tolerance. For example, let's say that you're 40 years old. This rule suggests that 70% of your investable money should be in stocks, with the other 30% in fixed income investments like bonds or high yield CDs. If you're more of a risk taker or are planning to work past a typical retirement age, you may want to shift this ratio in favor of stocks. On the other hand, if you don't like big fluctuations in your portfolio, you might want to modify the other direction. Open an investment account. All the advice about investing in stocks for beginners doesn't do you much good if you don't have any way to actually buy stocks. To do this, you'll need a specialized type of account called a brokerage account. These accounts are offered by companies such as Xtrade, Charles Schwab, and many others, as well as by new owner app based platforms like Robinhood and SoFi. Opening a brokerage account is typically a quick and painless process that takes only minutes. You can easily fund your brokerage account via an electric funds transfer by mailing a check or by wiring money, or if you have an existing brokerage account or 401k or similar retirement account from an old employer, you may be able to transfer these into your new brokerage account. Opening a brokerage account is generally easy, but you should consider a few things before choosing a particular broker type of account. First, determine the type of brokerage account you need. For most people who are trying to learn stock market investing, this means choosing between a standard brokerage account and an individual retirement account, or IRA. Both account types allow you to buy stocks, mutual funds, and ETFs. The main considerations here are why you're investing in stocks and how easily you want to be able to access your money. If you want easy access to money, you are just investing for a rainy day or want to invest more than the annual IRA contribution limit, you'll probably want a standard brokerage account. On the other hand, if your goal is to build up a retirement nest egg, an IRA is the best way to go. These accounts come in two main varieties, traditional and Roth IRAs. And there are some specialized types of IRAs for self-employed people and small business owners, including the S&P IRA and the Simple IRA. IRAs are very tax advantaged places to buy stocks, but the downside is that it can be difficult to withdraw your money until you get older. One interesting feature of Roth IRAs that can be appealing is the ability to withdraw contributions at any time for any reason. This can be a big positive feature for people who might not want their money tied up until retirement. Compare costs and features. The majority of online brokers have limited trading commissions for online stock trades. So most, but not all, are on a level playing field as far as costs are concerned, unless your trading options are cryptocurrencies, both of which still have trading fees with most brokers who offer them. However, there are several other big differences. For example, some brokers offer customers a variety of educational tools, access to investment research, and other features that are especially useful for newer investors. Others offer the ability to trade on foreign stock exchanges, and some have physical branch networks, which can be nice if you want face to face investment guidance. There's also a user friendliness and functionality of the broker trading platform to consider. I've used quite a few of them and can tell you firsthand that some are far more clunky than others. Many will let you try to demo version before committing any money. And if that's the case, I highly recommend it. 4. Choose your stocks. Now that you've answered the question how to buy stocks, if you're looking for some great beginner friendly investment ideas, here is a list of top stocks to buy and hold this year to help you get started. Of course, in just a few paragraphs, we can go over everything you should consider when selecting and analyzing stocks. But here is the important concepts to master before you get started. Diversify your portfolio. Invest only in business you understand. Avoid high volatility stocks until you get the hang of investing. Always avoid penny stocks. Learn for basic metrics and concepts for evaluating stocks. It's a good idea to learn the concept of diversification, meaning that you should have a variety of different types of companies in your portfolio. However, I'd caution against too much diversification. Stick with businesses you understand, and if it turns out that you're good at evaluating a particular type of stock, there's nothing wrong with one industry making up a relatively large segment of your portfolio. Buying flashy high growth stocks may seem like a great way to build wealth, and it certainly can be. But I caution you to hold off on these until you are a little more experienced. The wiser to create a base for your portfolio with rock solid established businesses or even with mutual funds or ETFs. If you want to invest in individual stocks, you should familiarize yourself with some of the basic ways to evaluate them. Our guide to value investing is a great place to start, where we help you find stocks trading for attractive valuations. If you want to add some exciting long term growth prospects to your portfolio, our guide to growth investing is a place to begin. Continue investing. Here's one of the biggest secrets of investing, courtesy of the Oracle of Omaha himself, Warren Buffett. You do not need to do extraordinary things to get extraordinary results. The most surefire way to make money in the stock market is to buy shares of great businesses, the reasonable prices, and hold on to the shares for as long as the business remain great. If you do this, you'll experience some volatility along the way, but over time, you'll enjoy excellent investment returns. Don't miss the second chance at a potentially lucrative opportunity. Ever feel like you've missed a boat on buying the most successful stocks? Then you'll want to hear this. On rare occasions, our expert team of analysts issue a double down stock recommendation for companies that they think are about to pop. If you're worried you've already missed your chance to invest, now is the time to buy before it's too late, and the numbers speak for themselves. Thank you guys for watching. We'll catch you guys next time. Bye.